You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today. Today I want to talk about a topic that crossed my phone, actually. I started to be on Blossom Social. It's a very cool social network about investment, mostly. Nice people, nicer than on Twitter, because sometimes, you can argue for nothing. And on Blossom, what I found that was really interesting is you have like a bunch of investors talking about different stuff. And one thing that I saw there was a lot of investors talking about ETF combinations. So they want to build their own portfolio package with several ETFs. And then a common combination that I've seen was going for XEQT. And I did a podcast episode on XEQT a while ago. And mixing it with some like VFV, for example, to get exposure to S&P 500, and then QQQ or another ETF focused on the NASDAQ. So long story short, start with XEQT and then get a little bit more of US market, get a little bit more of tech stocks, and then you'll be fine. And then I started to raise my eyebrows. I'm not a ETF investor. I prefer to invest in stocks. But the old financial planner in me was just like, are you not just creating duplicate in your portfolio? So let's take a look at what's inside XEQT, and we're going to talk about how you can effectively create a good combination of ETFs. So first, before we start, I'm not against ETFs. I prefer to invest in stocks because I really want to know what I hold. And you're going to see later on today, we're going to talk about how many stocks there is in XEQT. And of course, if it goes up and if it goes down, you have no clue why. I prefer to know exactly what's going on, and that's just me. But for people that has less time or less interest or less knowledge about the financial markets, going for broad ETF like this is probably the best thing you can ever do. Always invest according to your due diligence and your risk tolerance and all of that. You know this already. So let's take a look at XEQT for a second. So XEQT is a 100% focused ETF on stocks, well diversified across 45% in the US, 25% in the Canadian stocks, 24% in international, and the balance in emerging markets. So roughly 30% emerging markets, 25 Canadian, 45 US. So if you invest in XEQT and then you push a little bit more of the S&P 500, you already have almost half your portfolio in the S&P 500, and you're going to push a little bit more, and then you're going to push more into tech stocks where the S&P 500 right now is driven by tech stocks. So do you really want to go there? I'm not sure. I'm not sure if it's helping your portfolio, actually. But the thing here is you probably feel a bit uncomfortable having only one line in your portfolio, right? You invest in XEQT and you're just like, I have one line in my brokerage account, like one thing, like 1,000 units of XEQT, and that's my portfolio. It feels like some kind of like empty, right? It's not like dressed. You feel like nude. You're just like, there's something missing there. But have you went into that ETF first to see like what's inside? Just for fun, if you go on BlackRock website for XEQT, you will find out that there are actually 8,915 stocks. So 9,000 stocks in XEQT. And you really think you need more than that? Like than 9,000 stocks? That's kind of crazy, right? But then you're going to tell me, but Mike, I don't have exposure to fixed income. That's like a 100% equity play. Oh, then you start talking about the real good combination. So if you go for XEQT, but you feel that it's a little bit more volatile than what you would like to have something a little bit safer and have some kind of exposure to preferred shares or a bond ladder, well, you can add that as another ETF, and that would make a lot more sense. So then you would have XEQT, and then you can put like another 10, 15, 20, 25%, depending on like how much stable you want your portfolio in a bond laddered ETF or a preferred share ETF. And then you would have something a little bit more stable that would still generate an interesting return. Or you can go for stuff like Vanguard created those all-in-one ETF like VGROW. I kind of like VGROW as an a all-you-can-eat buffet, and literally because it owns like 13,500 stocks and 19,000 bonds. I mean, you cannot be more diversified than this, right? Still, the proportion is 80% equity, 20% fixed income. So it's kind of ironic that you have like almost 20,000 bonds for just 20% of your portfolio. But again, if you only have VGROW in your portfolio and you have all your money invested in that, you literally have all your money invested in 13,000 companies and 19,000 bonds. It cannot be more diversified than that already. You touch like the Canadian market, the US market, international market, bonds, you touch every single thing. So there's no need to have something else. I often have this question where like either like young investors starting like investing right now, well, go for that kind of all-in-one ETF or a broad ETF like XEQT. So you can start to learn a little bit more about the market, get diversified, but don't overcomplicate the whole thing. Because if you're adding more S&P 500 or you're adding more tech stock to your portfolio, you're not creating more diversification. You're actually concentrating your portfolio to more US or more technology exposure. Maybe that's the goal, but still, it's easier to do that with one ETF than adding like more and more. So the right way to do a good combination of ETF is first know exactly which kind of ETF you have in your portfolio. Take the time to look at the sector allocation, the asset allocation. Take the time to know which type of assets this ETF is tracking. Because if you don't know this, I mean, you're just blindly following some guys on Reddit or listening to a podcast and said, oh, Mike's like mentioned the word XEQT or VGROW, so I'm going to buy both and it's going to be fine. Well, not really. I mean, you really have to dig a little bit deeper and start thinking about which kind of exposure you want. If you want to have a mix of stocks and ETF, then what you could do is to have sector ETF or market ETF that you do not invest stocks in. So a lot of investors will prefer to manage their Canadian individual stocks because, you know, we know our companies, it's easier, it feels good because you drive by a Dollarama, a Canadian Tire, you see, like, it's kind of funny because every time I go buy wine at a SEQ in Quebec, it's owned by Choice Property, and there's like that small logo besides the door. So it keeps a good reminder. So that's great. So you have your Canadian stocks, and then you could decide to have exposure to the US market, and then it would be a good idea to either have a S&P 500 ETF or a NASDAQ ETF. You can add another one for international markets, but then, I mean, just put the brakes there. You have like 2-3 ETFs, you have like your stocks, and then you're good. So don't go crazy. The other way you can do it is to have specific sector that you would like to have exposure to, but you're not that familiar. So for example, especially for Canadians, we don't have healthcare companies that are great in Canada, or not enough to create a portfolio. So maybe you would like to have exposure to those big pharmaceuticals or those that sells medical devices. So you could decide to pick an ETF about healthcare, and you build the rest of your portfolio with individual stocks, and you have that exposure to sector. So this is a good way to create a good combination so you improve your diversification instead of creating duplicate that will not go any other way. So, guys, I hope that you have enjoyed this podcast. If you want to find me on Blossom, you can actually go on moosemarkets.com/blossom, BLOSSOM. So, moosemarkets.com/blossom. You will find my profile over there. You will be able then to download the app and connect. So, let's connect. Just hit me up. I'm starting to be on this platform, so not a huge following there yet, and I've not been that active, but I'm starting now. So it's going to be an interesting journey. And in the meantime, make sure that you have a clear combination, and maybe that the solution for your portfolio is to keep it simple. It's usually the best thing to do. So one ETF could actually work because it opens the door to thousands of stocks or bonds or both. So you don't need 50 ETF to have a great portfolio. So, all right, Moose, that's enough for today. Take good care. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.